5 things that you need to know about what happens financially when a spouse passes away. Stay tuned. I want to jump into a topic that is very dear to me, and it comes at a time where you're emotionally hit. Now what happens financially? And actually a lot of things happen financially. Let's talk about taxes first. What happens to taxes when a spouse passes away? And let's say, for example, you're a married filing jointly couple making $150,000 a year, and that puts you squarely into the 22% tax bracket, right? You still got about $57K in 2025 within the same tax bracket, squarely in that tax bracket, no harm, no foul. But a spouse passes away, and people often think, oh, my expenses will go down. And what we find is usually not. If you have a mortgage, your mortgage stays the same. Maybe your food budget goes down a little bit. Maybe you only have one car instead of two. Some expenses will go down, but you're not going to go from $150,000 of income need or a budget down to 75. That's not going to happen. And as a single filer making $150,000 a year, you technically jump into the next tax bracket. You're now at 24% instead of 22. So you just went up a whole tax bracket. Additionally, if you're on Medicare, income-related monthly adjustment amount, it's called IRMAA, not your great Aunt Irma, just normal IRMAA, you're actually going to jump 2 IRMAA tiers, where for your Medicare Part B and for your Medicare Part D, you'll actually be charged more per month, every single month that you're on Medicare. Now, again, I say that not as something that you can really plan for it, but it's important to know up front. Taxes and Medicare more than likely will go up when your spouse passes away. Now let's jump to Social Security. Social Security will also change. For again, both of you taking Social Security and a spouse passes away, the current rules in 2025 are that the surviving spouse will jump to the higher wage earners Social Security benefit. And depending on when you took your Social Security benefit, it could be as high as 100% of the survivor benefit or 100% of the higher wage earners benefit, or it can go down percentage-wise depending on when you took it. If you took your Social Security benefit early, like at 62, they penalize your benefit, your individual retirement benefit, and they penalize a survivor benefit. Now, important to note though, survivor benefits for Social Security are technically the only one that you can take and then switch to another benefit. So if you're a survivor and let's just use an example, a hypothetical example, and both of you are age 60 and the spouse passes away, the surviving spouse can actually collect a survivor benefit at age 60. And then allow their individual benefit to grow over time and switch to their individual benefit at age 70. It's the only benefit right now that you can take and then switch. But assuming, let's say, most retirees that we work with, a client will take at 67 and maybe the higher wage earner will take at age 70. And let's say for hypothetical purposes, the higher wage earners at $4,000 a month, the lower wage earners at $2,000 a month. When a spouse passes away, the surviving spouse will either retain the $4,000 a month or the $2,000 will become $4,000 and the $2,000 benefit drops off. Unfortunately, you don't get to keep both benefits. You only get to keep the higher benefit. The other thing is Social Security right now sends you a $255 check, which has been that way for a very long time, which will probably pay for the coffee at the funeral. Or maybe about 6 flowers. I'm teasing. I'm totally teasing. But it's important to know from an income standpoint what will happen to your Social Security when a spouse passes away. Now let's jump into pensions. Depending upon what survivorship you selected on your pension, that will obviously go to survivor. So when you elect your pension benefit, it's called a single life pension or a single life annuity is usually the highest dollar value because they're only protecting your life. But if you add survivorship, like 50%, 75%, 100% survivorship, what that means is they reduce the benefit because they begin to cover more than one life of your spouse specifically. 100% survivorship means when you pass away, your spouse gets all of it. 50% survivorship means when you pass away, spouse gets 50% of it. I mean, hopefully that makes sense on the podcast or on the screen. But it's important to understand pension, Social Security, taxes, and then let's jump into assets. So most of the time, retirees have their accounts in 401ks, traditional IRAs, Roths, or joint accounts, individual accounts. And those should have designated beneficiaries on them. So this is a takeaway. This is an action item. Go look at your statements, go look at your accounts, and determine, do your accounts have designated beneficiaries? Because the good news is, with a designated beneficiary, those accounts will bypass probate. Those accounts will not have to go through probate in your state. Usually the beneficiary just has to provide a death certificate and a place to send the money, and the money will be sent. Again, clients that we're working with right now, it takes around 30 days in order to receive those funds versus probate, which depending on which state you're in can take 9 months to, the millennia. That was a joke, but it can take a long time. Designated beneficiaries will save a lot of time and energy and money for your estate and for your beneficiaries. Most of the time we see clients have a primary beneficiary, right, the first in line, and then contingent beneficiaries. And that's an excellent thing to do for you, for your spouse, and for your kids or contingent beneficiaries. Make sure those are on those accounts. It's very easy to do. Typically, all I have to do is put their information and sign a form, and then it will save time, energy, money when it comes to probate. Taxes, Social Security, pensions, and assets is what happens when a spouse passes away. And it's great to look at your plan, write it out. How much income do we lose should a spouse pass away? What happens to our taxes? My taxes, looking at the tax brackets when a spouse passes away, making probate, or at least the estate planning, as easy and simple as possible. That's how you can prepare you and your spouse, and again, in the best way possible, to deal with the emotional aspect or the emotional place that you're in. Our kind of rule of thumb with clients and what we strive to do is that the surviving spouse won't have to take any major financial decisions, at least for the first 12 months. That means won't have to sell a home and move with the kids. Won't have to, take tons of money out to replace pension income or that Social Security income. Really no major, huge decisions within the first 12 months, because it's really important. We want spouses to go through the grieving process and to be able to come to what a new normal will be. Again, the goal is without having to take major financial decisions, and also hopefully having a coach and a guide in your financial planner and their team. That's how clients can wade through those very troubling times. Only about 3% of you who watch hit that subscribe button. It does mean a lot to us, and we're going to continue to send great content your way to make sure that you can wade through these troubling waters of retirement and those things together. So please hit that subscribe button, that like button. It means a lot, and we'll see you on the next video.